Hi, Christian. Happy New Year. 2024 was a year filled with elections around the world, including the US election. Markets reacted positively to the quick and decisive Trump victory. But the question remains whether or not this is a rally with legs. What are your thoughts?
Happy New Year, Christina. Yes, indeed, you're right. The US election went rather smoothly. But when I think about potential policies that will come out of that election, I believe there's still a lot of uncertainty today. And then you look around the world, you look at Germany, you look at France, you look at South Korea, Mexico, most recently Canada, and sort of a picture of political uncertainty emerges going into elections or coming out of elections. Yet the US markets don't really seem to care. I mean, we're coming off another year of very strong performance, but all of that is in the rearview mirror. What we're really interested in is prospective returns. And I think it always helps to go back to the numbers. And when you look at the S&P last year, the S&P, because of its massive concentration in large companies that all evolve around that theme of AI, the S&P outperformed the equal-weighted S&P by about 12% last year. And it already outperformed the equal-weighted S&P by 12% the year before. The last time you saw that kind of divergence between the S&P and the equal-weighted S&P was during the height of the tech bubble. Meanwhile, the correlation between international and US stocks has broken down. Last year, US stocks outperformed by about 20%. And again, the last time we saw something similar was during the height of the tech bubble. So considering the setup, political uncertainty all over the world, US markets at record valuations, very concentrated indices, if you consider that setup, I think it warrants some prudence. And in statistics, we differentiate between risk and uncertainty. Risk is something you can model quite easily. Uncertainty you can't model. What you really look for in uncertainty is resilience, or even better, anti-fragility. It's a term Nassim Taleb coined. And one way to get that anti-fragility is with the barbell approach. And if I take that concept of barbell and apply it to investing, to portfolio management, I feel very good today having a portfolio with, on the one hand, productive businesses with strong market positions all over the world, trading at reasonable valuations relative to cash flow. And then on the other side, to have some gold as a potential hedge against tail risks in financial markets.
Now, speaking of uncertainty, can you speak to the potential implications that the new administration's policies may have, and how are you taking this into account when evaluating opportunities?
This is one where we usually say the crystal ball is foggy at best, but I will say this. When you look at US markets today, they're clearly imputing a very positive outcome of the policies from the new administration. And I think it helps to just go back and look at the first term. And one thing that's quite clear is there was a big gap between Trump's rhetoric on the campaign trail and what ultimately got implemented. One thing that is quite different this time around is there's some real constraints in terms of inflation and interest rates that didn't exist the last time. If you remember, inflation was non-existent and interest rates were close to 0%. Meanwhile, he does have some ambitious policy goals, and then you potentially have some deportation and some tariffs, and all of that is quite inflationary in the face of these real constraints that exist today. So could we see a situation where the bond market forces some fiscal discipline, maybe similar to what we've seen in the UK a couple of years ago under the Liz Truss premiership? And another way to think about it is gold and equities went up in lockstep over the last 2 years. That's highly unusual. What if that actually tells us that what really happened is that money already is starting to lose some of its value? Now, at the same time, if you take the Department of Government Efficiency, DOGE, at face value, that would lead to some fiscal consolidation. But keep in mind, one reason the US has done so well the last few years has been massive fiscal deficit spending during a time of full employment, of low unemployment, which is highly unusual, and that provided an artificial boost to the US economy. If DOGE succeeds, some of that artificial boost will naturally moderate. So what are we going to do in that kind of environment where you have all of these different moving parts? We stick to a philosophy that we have stuck to for 45 years at this point, which means we are trying to take advantage of uncertainty. We are trying to take advantage of noise, use it in our favor, and find good businesses that we believe have gotten unduly punished. And when we look at the world today, we see interesting opportunities in such varied areas as US healthcare, South Korean tech, Japanese industrials, and European consumer names.
Thanks, Christian. It was nice to see you.
Thanks, Christina.